Welcome everybody to our mid-week briefing. Interesting week, actually. Over the past several weeks, really, in fact, since the beginning of the year, the US economy has been the one that's been sticking out as the real strong economy that's really powered ahead, certainly compared to the UK and the Eurozone. Obviously, there are other issues going on the other side of the world. In China, there's a concern that growth is slowing there, and we've had a few bumps in the markets because of that. But really, the US has been the one that's given us a lot of encouragement. And as you can see, if you look at the NASDAQ, if I go to, don't know whether we can get a chart. I'm on the NASDAQ here. What's the code? Dollar NDQ, I think it is. Or was it NDX, actually? Dollar... Oops. Just put in dollar, I think it's an NDX. I just want to show you... okay, that's the DAX. Okay, so this is the NASDAQ. I'm just going to show you a daily chart so you can just see exactly what we've been doing. That is the NASDAQ, everybody. This chart at the top is the daily chart of the NASDAQ. It's the more sort of technology-laden index in the States. You've got the main index, which is the S&P 500. The Standard & Poor's 500, or the S&P 500, is the largest index, certainly by market cap, in the world. It has the top 500 companies in the US by market capitalization. What do we mean by market capitalization? Really the value of the company, i.e. what the shares, number of shares in issue multiplied by the price, tells us what the market capitalization is. And it's got the top 500, so it's a very, very important index. The NASDAQ is slightly different. It's still calculated by market capitalization, but as you can see, it's been an astonishing move since the beginning of the year, and that really underscores what's going on in the US equity markets. It really mimics, or sort of, it looks exactly like the chart for Apple. Apple is an extraordinary company that has just gone ballistic, and every time they bring out a new product, although I'm not sure the iPad 3 was a new product, but an extraordinary run. The laws of supply and demand. Does everyone understand the laws of supply and demand? Any feedback here? Anyone understand laws of supply and demand? They're fairly straightforward. They apply to everything that we deal in. Not just the financial markets, for the price of any goods, anything really. But they do apply to the financial markets in exactly the same way. We have a supply of dollars, and we have demand for dollars. We've got supply for credit and a demand for credit. And it's when the demand increases and supply stays stable that prices will go up. If demand stays the same and the supply goes up, the prices come down. And this is important we understand this, certainly in the financial markets as well, because this is what affects interest rates, which is basically, as economic activity picks up, there's a greater demand for money. A greater demand for money pushes up interest rates. Interest rates go up, bonds go down. So, what we're going through at the moment is quite a tough phase in the economy. We're in a transition period. We've gone from the extreme situation, or we're moving away from the extreme situation that was in October '08, March '09, and more recently August last year and late October last year. But it's a painful process, everyone. It's not something that we can sort of rush. There's been some massive dislocations in the market, and we need to recover that position. But normal markets are where equities represent, or underscore an improvement in the economy when they're going up. And normally when equities are going up, there's a greater demand for money, demand for credit, and there's pressure on interest rates. So bonds typically go in the other direction. But with this liquidity crisis, which is an extraordinary event over the last 4 years, you've had basically the intervention from central banks and governments to pumped massive amounts of liquidity into the market, and you've also had the risk aversion where people have been buying sovereign debt, or at least the less risky sovereign debt. So you've had bonds, those sort of bonds and equities really sort of have sort of tended to track each other a lot, ironically, certainly in the recovery phase at least. Harry, supply decreases, prices go up. Well, what happens is, if you've got a constant, so basically, if supply stays the same and demand goes up, prices will go up. If supply drops and demand goes up, then you'll have a rapid increase in prices. Either way, if supply is reduced, you will then have a positive price pressure. If demand increases, then you also have positive price pressures as well. So really, this is one of the reasons why, if you've noticed, Harry, when there is talk of QE, and I'm going to go on to that in a second, quantitative easing, everybody, is effectively the printing of money. We've done it here in the UK to the tune of 325 billion. In the US, they've done massive amounts of it. They've still got an ongoing QE2. QE3 has been discussed. That basically increases the supply of dollars. So effectively, if you print money and introduce that into the financial system, that is going to increase the supply of dollars. If you have constant or unchanged demand and you increase the supply of dollars, you are going to weaken the price of dollars. So, yeah, that's you're going to. So by increasing the supply, Harry, you will reduce. You will cause the dollar to come off. So your question about decreasing the supply, that would push it up, but QE obviously is increasing supply, and that's one of the reasons why you've seen the dollar actually take a bit of a leg down. You've seen dollar euro trading up to the sort of 133, what it is at the moment. Have a quick peep. 133.56. Really shouldn't be up here, but you know, there's the US authorities seem to be a lot more sort of aggressive with regards to the economy, and they've got a lot more sort of free rein than the ECB seems to have. Certainly, Mario Draghi is taking a lot more sort of active role in managing things as opposed to Trichet, the previous incumbent chairman of the ECB. So, we've had a good run in the US economy. The numbers have been fantastic. I think last week there was a sort of a concern that we were coming to the end of the bond market rally as the US economy really did start to take off. And obviously, the paradox with all of that is as the bond markets start to come off, i.e. price pressures start to push interest rates up, that actually starts to become a negative for a lot of investors, because that also was suggesting that Ben Bernanke and the Federal Reserve would not engage in another round of QE. Okay, so that was the picture last week. So there were concerns that this will keep interest rates at historically low levels until 2014 was all very well, but if economic conditions changed and there was a perception that things are really taking off, that they'll have to change that, and the market was starting to price in movement in interest rates well before 2014. Now you're probably asking, well, what the hell does this all mean? Well, it can have an effect on the dollar, it can have an effect on expectations, and in this fragile recovery that we still probably would regard it, it could actually dampen the market down significantly. So a lot of this is to do with talk. Going back to talk, okay, now I'd like to review what happened on Monday, because it's important you understand all this stuff that was coming out. I have to say, I was a little bit surprised. We discussed on Monday, if you remember, and I'll get my little highlighter here. On Monday, my little highlighter's not working because Adrian's recording this, and it's sort of looking a bit strange. Okay, well, on Monday we had Ben Bernanke talking. We discussed this. Normally, the chairman of the Federal Reserve does not say things that are going to tip the market up in any way. it's designed to a lot of what he's going to say is designed to be in line with very much with what he is. He and the Federal Reserve has been communicating with the market. So gone are the days when you'd have, Ben Bernanke says interest rates are going up. They would never do that. In the old days, where Volcker was in charge and even Greenspan, they're a lot more transparent and they communicate with the markets a lot further ahead these days. So typically we wouldn't expect too many shocks. But actually, there you go. So on Monday, where can I go to? Let's have a look at global economy. Okay. I can't find the actual article. The Bernanke bounce. Basically, what Bernanke said on Monday in this speech that we discussed that he was making at 1 o'clock, it was about employment actually, and this was the first time that Bernanke had a chance to talk about employment. So you've got the backdrop of a strong economy, the potential for an increase in demand, interest rates starting to move up, but he went and said, well, actually, I think that there is doubt about the US jobless figures. They've been falling quite dramatically, actually. The unemployment rate's fallen from 9.1% to 8.3% over the past 6 months. But he thinks he being Ben Bernanke, he thinks it's a sort of a one-off effect after the big job cuts that we had in 2008, 2009. So he really would like to see a more rapid expansion of production and demand from consumers that would support further increases in employment and a drop in the jobless rate. What this meant to the market, it meant initially that, hey, okay, good news, we're going to have more of that drug. What's that drug? That's QE. QE, we're going to get more money. Fantastic. Let's get that money at record low interest rates and let's put it into the stock market. It's sort of a bit of a no-brainer, really. But of course, when people analyse what he'd said, so the market was very, very strong on Monday. And I think if you remember, I don't know whether you sort of followed it too closely, but stocks actually rose to their highest level in 4 years on Monday. You had gold rallying sharply. And really, that's because most investors interpreted, although incorrectly so, that QE3 remains a policy option. But I don't think it does. I think they'll maintain the policy they've got, but I think they've got to be very careful that they don't overcook this. So as a consequence, I think the market's now having to deal with, cut a long story short, I think the market's confused. The market now wonders, okay, it was going well. We've enjoyed some fantastic employment data. Consumer confidence has been good. And now, all of a sudden, we've got the chairman of the Federal Reserve, who gets an inside track on every bit of data going, is worried about unemployment. So there you go. So now you know why the market fell yesterday, and you know now why the market is under a little bit of pressure this morning. I'm just having a look at what the FTSE is doing just now. Yeah, we're down. We're down 14. It's not really doing too much. We were sort of 10 off on the opening. We're about 25 down at its worst. It's sort of picking up a little bit actually from its lows at the moment. But that's really what's going on now.